Good evening, and welcome to today's market wrap. If we had to sum up today's session in one word, it would be risk off. From Asia to Europe to the United States, investors voted with their feet, fleeing risk assets and rushing into the safe havens of gold, crude oil, and treasuries. Let's start with the numbers. The Nasdaq Composite fell 1.4%, closing at 25,520. The S&P 500 dropped 1.01% to 7,457. The Dow Jones Industrial Average was the relative outperformer, down just 0.77% at 52,146. But the real pain was felt in China. The Shenzhen Chinext Index, which tracks growth stocks, cratered 7.14%. The Shenzhen Component Index lost 5.4%, and the Shanghai Composite fell more than 3%. This was not a normal correction. This was a systemic panic sell-off. The trigger was clear: escalating military tensions in the South China Sea, which sent geopolitical risk premiums soaring. The CBOE Volatility Index, or VIX, spiked 12.19% to 18.77, confirming a complete reversal in risk appetite. The capital flow story is textbook. Money is fleeing technology and cyclical stocks and pouring into traditional safe havens. Spot gold surged above the $4,000 mark, gaining 0.92%. WTI crude oil jumped 3.61%, breaking through $81 a barrel, as the geopolitical tensions directly threaten shipping lanes through the Malacca Strait. The 10-year Treasury yield fell to 4.54%, down 0.61%, as money also flowed into government bonds. Now here is an interesting nuance. The US dollar index was essentially flat, holding near 100.75. This tells us that global capital is not rushing back to the United States. Instead, it is flowing directly into commodities and gold. We also saw a significant divergence in performance between US and Chinese equities. US markets fell, but only by 0.77 to 1.4%. Chinese markets, by contrast, fell by 3 to more than 7%. That gap suggests that US markets have not fully priced in the panic emanating from Asia. There is a real risk of a catch-down move in US futures on Sunday night or Monday morning. So what is the market telling us today? First, we have transitioned from a market that was trading on macro data to one that is now pricing in geopolitical risk. Second, the linkage between energy stocks and defense stocks has been established as a new leadership theme. And third, the persistent strength in safe haven assets is the clearest signal of where money is flowing. Looking ahead to Monday and the early part of next week, our strategy is clear: wait and hedge. Do not chase the sell-off in Chinese equities. Do not add to risk assets like technology or growth stocks. If you hold long positions in US equities, tighten your stops or consider buying VIX call options as a hedge. That said, if we see clear signs of de-escalation in the South China Sea over the weekend, such as a withdrawal of vessels or official statements aimed at cooling tensions, then all bearish and hedging strategies should be abandoned immediately in favor of a neutral stance. The overarching message tonight is that risk management takes priority over offense. Investors should watch the weekend headlines closely. Pay particular attention to the open of crude oil futures on Monday. If oil opens higher but then reverses and falls more than 2%, that would be a signal that the geopolitical premium is being priced out, and risk appetite could stabilize. But until then, stay cautious, hold cash and safe havens, and let the dust settle. That is our view from the trading desk tonight. Good night and good luck.